Hi, good morning everyone. Welcome to the board meeting. Firstly, I want to ask a simple question. Every year, the companies spend more than 2 trillion on acquisition. So do you know what is the MA successful rate to create value? Probably you will say, okay, there will be 6%, 70% successful rate. But actually, based on the literature and the research, we know that MA successful rate is only between 10 to 30%. So what happened here? You may not easy to make any deal, but today our team will bring here a very promising deal. We probably will have strong interest because there will be most promising in the last 2 years. So do not miss out. Here, when I say that, because we found Oracle is a leader in the software industry, while the Sun Microsystems, there will be the leader in the hardware. So do you think about whether they can combine together? So what is the strategy rationale for combining them together? We here can make a strong recommendation that acquiring Sun Microsystems can process valuable contributions to the Oracle because they can give the one-stop shop strategy, and there will be significant synergy to the Oracle success. Why we say that? Because this strategy will help to enlarge into the new market and then to get more portfolio, to reduce the cost, capitalize the Sun customs bases and contracts, and it also can enlarge the talent pool in the engineering expertise. As you know that actually the MA contains two main parts. One is strategy, one is valuation. For the valuation part, we both adopt the income approach and also market approach. For the income approach, we have using the discontinued cash flow analysis, which provide insight into long-term cash flow potential and which is very fit for the strategic aspect. For the market approach, we have using comparable company analysis because we want to know that how about the clear market trend and then whether they will have some similar public company that can reflect its relative value. And then we will using this value approach to get the fast financial insight to have brief idea.
First, we need to calculate the WACC for Sun Microsystems, assuming a tax rate of 35%, a market risk premium of 6%, and a risk-free rate of 3.66%. We get a WACC of 12.72% for Sun Microsystems. That means the company must earn at least that amount of return on its investment in Sun Microsystems to meet investors' expectations. If the company ends up earning less than that, it won't be able to create value for shareholders. This calculation ensures that a fair price is paid and reflecting the risk and return of the investment. Through our calculation, we find that some microsystems WACC is higher than the average of the risk of the industry, which can prove that some microsystems may be considered a riskier investment than some of its peers because of its higher cost of capital. Therefore, we will also consider whether the company will be less attractive when compared to other companies with low capital cost.
So here's the DCF valuation. About the assumptions, we already got the WACC, and we assume that the perpetual growth rate is 5%, which accounts for the inflation and the market expansion over the long term. And about the tax rate, we assume that the tax rate is same with the Oracle's effective corporate tax rate in 2009 estimated, which is 28.6%. And about the change in working capital, we assume that it's 1% of revenue for each year. And as you can see, the EBIT is negative in 2009 estimated. It caused the total present value of the free cash flow become negative as well. As a result, the equity value per share becomes $5.99, and which is relatively lower than the market price at that time, which is $6.67. And it shows that our concern about the difficulties that Sun Microsystems faced in 2009, and also, as we all know, the numbers don't lie, so it may seem not a good deal. When it comes to the peer comps, we choose the enterprise value divided by LTM revenue, EBIT, and EBITDA as our multiples. So we first included the AMD since the multiples are all negative, and we excluded the net app since all the multiples are significantly higher than the others. Then we choose the median of each column as the Sun Microsystems multiples. And as you can see, we use the fiscal year of 2008. That's because the fiscal year 2009, Sun Microsystem got a negative EBIT and EBITDA. And also we giving the weighting of the LTM revenue at 0% because they made a huge revenue, but they don't make money. And as a result, the concluded equity value per share is $8.84, which is a little bit higher than the market price and higher than the, of course, DCF valuation. But makes it a good deal? Of course not. After you see my colleague show our synergy models, and you understand that why the Sun Microsystem need our help to complete the acquisition.
Based on our synergy analysis, we identified several synergies that could have material impact on the company's future financials. First, after the acquisition, there will be integration cost of $1.1 billion with $750 million spent in 2010 and the rest in 2011. We also expect an initial loss of $45 million in 2011 due to delayed purchases and customer attrition. In the long term, we expect the company to reduce its workforce, and this could cut SG&A expenses by 22 to 32%. Meanwhile, other synergies like licensing income, launch of new products, are projected to boost operating profit by up to $900 million each year and will gradually take effect over the next 3 years course. To evaluate the synergies of this transaction, we did another DCF valuation that factored in the synergies mentioned above. In this model, we assume 22 SG&A expense cut, and for other synergies, we focus them to first realize 40% in 2011 and reach to 100% in 2013. To make a fair comparison with the standalone DCF model, we kept all other assumptions unchanged. The result shows that the post-deal synergies would add around $10 billion to the company's enterprise value. We did a sensitivity analysis to see how synergies might impact enterprise value. The two main factors we looked at is the first, the percentage reduction in SG&A expenses, which range from 22% to 32%. Second is the percentage of synergies that can be realized after the 3-year integration period, ranging from 20% to 100%. Then we compared our findings with the buyer's offer price, which implies an enterprise value of $5.6 billion. Our sensitivity analysis shows that for one, the company's enterprise value could fall between $4.3 billion and $15.6 billion, and depending on different scenarios. Second, to achieve a synergy premium over the acquisition value, the synergy realization rate should not lower than 40% for years after 2013.
Based on the calculated equity value per share, it's clear that the potential value of synergies significantly increase the valuation. Therefore, once a competitor participates, Oracle will choose a 40% premium to complete the acquisition of Sun Microsystems. Therefore, the price per share may rise to $8.39, and considering the market dynamic, if more competitors participate, the stock price may rise to the range of $10.07 to $11.75.